Good day, everyone. Today, we are going to discuss risk management and insurance of Module 14. Insurance is one of the most important parts of your risk management plan. By purchasing insurance, individuals can transfer their personal risk to a third party, the insurance company. Today, it is possible to insure almost anything. Understanding the different kinds of insurance available and evaluating potential losses helps consumers make more informed. Insurance premiums are based on the potential risk and potential losses they will have to pay to the group members. While insurance premium sometimes seems rather high, the rates vary from person to person depending upon personal risk factors such as age, health, personal behaviors, employment, and credit ratings. In return for paying the premium, you receive an insurance policy from the company explaining your rights and responsibility when using the insurance. An insurance policy is simply a contract between you and the insurance company outlining what is covered, the limits of your coverage, and whatever procedures you must follow to maintain the policy and collect any payments for your losses. While the insurance company will pay the greatest part of your loss, generally you will also pay a small part as well, in addition to your premium. The additional amount you pay when filing a claim with the insurance company is called the deductible. The deductible is the term used for the amount you insured are willing to pay before your insurance policy picks up the risk. It represents the portion of the risk you are prepared to cover from your personal savings. You will often hear the phrase after you meet your deductible to indicate the amount you must pay before the insurance policy takes effect. When making insurance choices, you should consider the following. First, is this insurance necessary? If the potential loss is large, it could be financially devastating to you and your family. If the potential loss is small, you may have savings or other financial resources to cover it without insurance. Next, how much insurance is needed? Do you want to cover the minimum loss or do you need to cover the cost to replace whatever you may lose? Next is how much will it cost? Do the benefits of purchasing the insurance outweigh the cost? In return for paying the premium, you receive an insurance policy from the company explaining your rights and responsibility when using the insurance. An insurance policy is simply a contract between you and the insurance company outlining what is covered, the limits of your coverage, and whatever procedures you must follow to maintain the policy and collect any payments for your losses. While the insurance company will pay the greatest part of your loss, generally you will also pay a small part as well in addition to your premium. The additional amount you pay when filing a claim with the insurance company is called deductible. The deductible is the term used for the amount the insured are willing to pay before your insurance policy picks up the risk. Again, the additional amount you pay when filing a claim with the insurance company is called deductible. The deductible is the term used for the amount you, the insured, are willing to pay before your insurance policy picks up the risk. It represents their portion of the risk. There are many types of insurance, almost more than you can list. Whether it is health, disability, life, homeowners, renters, or auto insurance, understanding how insurance companies calculate risk and the standard features of insurance policies will help you make the best choices for your personal needs.
Health insurance, also called medical insurance. It helps you protect and your family from expensive and unexpected healthcare related expenses. It is designed to estimate your overall risk of health related expenses and supplement your cost for care, including doctor's appointments, hospitalizations, prescriptions, and other similar costs. Originally, health insurance was designed to cover catastrophic health related expenses but has been gradually expanded to include more preventative care. Some employers will pay your premiums as part of your benefit package with the company. Having insurance through an employer is generally much less expensive than buying it on your own because employers can pool those who are healthy and spend minimal amounts on healthcare with those who have numerous health problems and frequently use their healthcare benefits. If purchased individually, the insurance company will base the premiums on your personal risk factors such as age, overall health, and previous health problems. Most insurance policies do not cover all health care costs. You are still responsible for certain out-of-pocket costs, and the deductible other costs can really add up and often include. One of those is co-payment. The amount you will have to pay each time you visit a healthcare provider. A co-pay is generally 25 to 35 and is collected when you sign in for your doctor appointment. Second is the co-insurance. The percentage of your medical cost you will need to pay after meeting your deductible. Traditionally, your insurance company would pay about 80% of your medical cost and you would pay the other 20%. However, co-insurance amounts today vary greatly, making it an important feature to check out before making a decision. Co-payments, premiums, and out-of-pocket expenses depend upon the type of health insurance you have. A plan called a PPO tends to have more out-of-pocket costs than an HMO, but PPOs offer more flexibility when choosing a doctor and other services. A PPO is a preferred provider organization and an HMO is a health maintenance organization. Be sure you are familiar with the options both offer before you agree to the coverage. The best health insurance plan for you is the one that gives you the greatest flexibility and the most benefits for the lowest cost. There is no standard health insurance plan or a one-size-fits-all policy. You will need to compare costs and benefits before choosing a plan. Next is disability insurance. Disability insurance, also known as disability income insurance. It is another type of medical coverage. It pays part of your income if you become ill or injured and need an extended period of time to recover or if you can no longer work. Next is Medicare. Medicare is a health insurance program provided by the federal government to people over the age of 65 or with certain health conditions. Next is the Medicaid. Medicaid is another type of federal health insurance, and it pays healthcare costs for low-income citizens of all ages. It is administered by state and local governments, which also provide matching funds to offset the cost. And next is the long-term care insurance. Long-term care insurance helps cover costs associated with care in a nursing home or other similar facilities if you become unable to take care of yourself. Generally, people who need long-term care require assistance with daily activities such as dressing, bathing, and walking, etc. Life insurance. The main purpose of life insurance is to insure against loss of income due to death and can also be used to retirement planning and investing. It is the one kind of insurance you pay for but only other benefit from it. Except in rare cases, the purpose of life insurance is to provide for others at the time of your death. Life insurance companies offer a wide array of policies to meet your needs as your personal circumstances change and evolve. Following is a brief description of the three kinds of life insurance. First, term life or temporary insurance. It provides coverage for a defined time period, generally 5, 10 or 20 years, pays cash benefit to a named beneficiary if the insured dies during the term of the policy. Next is the whole life insurance. It covers the insured for their whole life. Benefits are paid to the beneficiaries when the policyholder dies. Next is the universal life insurance. Whole life insurance with more flexibility allows the policyholder to maintain their policy and still make changes such as decreasing the death benefit or changing the premiums. Next is the liability insurance. Liability insurance protects you when others claim to be hurt or injured as a result of something you did or did not do. Generally, it pays medical bills or provide compensation to anyone who can prove you were negligent or acted improperly. Most states, including Oklahoma, require you to have liability insurance on your automobile in case you are involved in an accident. Damage or injuries caused intentionally are not covered by liability insurance policy. Next is the homeowner's insurance. Having homeowner's insurance protects your investment against disasters such as fire, tornadoes, busted pipes, robbery, and other similar problems. Most standard homeowner insurance policies cover your house, the structure itself, and the contents or any personal property you have in the house. And in addition, the majority of homeowner insurance policies provide liability coverage in case of someone visiting your home is injured. You have the option to purchase homeowners insurance that covers either actual cash value or replacement cost. Actual cash value is the amount it would take to repair or replace damage to your home after normal wear and tear. It is commonly called depreciation. The replacement cost is the amount needed to replace or rebuild your home or repair damages with materials of similar kind of quality without deducting for depreciation. Few, if any, homeowners insurance policies covered flood damage. Beware. If you live in an area prone to flooding from any cause, hurricanes, rivers, or streams, be sure to ask about purchasing flood insurance, which is available through the federal government's National Flood Insurance Program or NFIP. In some areas, flood insurance may be required. Consult your insurance or real estate agent for more information. An insurance tip. Take an inventory of all of your personal property, along with a photograph or video of each room. Also, save your receipts for major items and keep them in safe place away from your house or apartment. Having this information will make it easier if you ever need to file a claim. Next is the renter's insurance. Renter's insurance protects renters from the theft or damage of personal items or furniture, TV, computer, clothing, etc. in their apartments or their cars. A good renter's insurance policy will also include liability insurance, that you can be held responsible if someone is hurt or injured while visiting your apartment. Liability insurance is your best protection. Generally, renter's insurance can be transferred from one location to another when you decide to move. Next is the automobile insurance. Automobile insurance limits financial loss due to damage or a car accident. If a tree falls on your car or it is damaged by a hailstorm, your comprehensive insurance policy covers your claim and helps offset the cost of repairs. More importantly, auto liability insurance pays for someone else's property or injuries. If you are at fault in an accident, it is called bodily injury and property damage coverage on your policy. In addition, your insurance will pay if the other person is uninsured. Your policy is required to have uninsured motorist coverage for your injuries. You can also purchase comprehensive insurance to cover your vehicle if it is damaged by an act of nature or if it is stolen. As an added protection, you can purchase collision insurance to pay for your car repairs if the person at fault in an accident does not have insurance. As you can see, automobile insurance is an important tool for managing your risk. Trying to cover the cost of repairs and injuries without insurance is extremely expensive. This is a tip. Giving others your keys. If a friend has an accident in your car, it goes on your insurance record even if they have insurance. It may not matter because you are responsible for who drives your car. The accident will go on your insurance record and you will pay higher premiums. So, be careful who gets your keys.